Understanding whether a market is balanced or imbalanced is the foundation of smart trading. But do you know how to spot the difference effectively? So in this video I'm gonna break down the difference between balanced and an imbalanced market. I'm gonna teach you how to identify them, and I'm gonna show you how to trade effectively in each condition. Now, just to let you know, in the bio of this video you're gonna find a free link, free invite for the Discord and the Telegram, and also a 2-hour bootcamp. Also, if you want to be working closely with me, you can join my private network, which at the moment is being unlocked. So if you want to join, you can do that before it gets locked up again. Inside, you're gonna find 200 hours of education, all the alpha packed in one place. You're gonna find daily updates, weekly outlooks, live trading, my personal positions, and trade as well. This is how much profit I made for January. I made 30k for January, and I traded everything live in the Discord. Let's get straight in the video. So the definition of a balanced market is essentially where periods of consolidation, and in these periods of consolidation, buyers and sellers are in perfect equilibrium. Overall, in terms of characteristics, this means tight trading ranges, low volatility, and also price often respects support and resistance levels in between them. Think of a balanced market as a tug of war where neither side is winning. This is a screenshot of a very well balanced market. So you can see we're rejecting the volume high, we're coming back down to the volume low, coming back for the volume high, slight deviation, coming back in, volume low, volume high, volume low. So this is the balanced market where essentially you are being in that rotational place. Now the imbalanced market, this is where one side is dominating. So when the buyers or the sellers are taking control. So this is what happens when you have breakout or breakdowns. This means you're gonna have high volatility and large price moves, and this is often fueled by either news or large orders. An imbalanced market is when one side finally overpowers the other, and this is creating this type of explosive moves. So as an example, you saw that we were in that balanced market, and then we create the imbalance and we leave the previous balance. And what do? We look for a new balance because you just left the prior one. This is the example where you create the imbalance and you start impulsing. You essentially started impulsing when you created that imbalance. This is another example where you have a very high time frame volume high and volume low, very high time frame balance between 2.9 and 3.6. You go above 3.6, you try to, you do have a breakout with a big imbalance, but you see that's a very big candle, which did happen because of the ETF news. But overall, what do? You try to create a new bounce, but you fail to continue in that rotation, in that direction. So what do? You deviate, you come back in, you backtest the VAH 3 times, and then you have a final rotation down to the value low. You come up to the point of control, you fail to go above it, you fail to rotate to the value high. This is called a failed rotation, and when you have a failed rotation, this is a predisposal to breakdown. And this can happen in either from value high to value high, from VAH to VAL, or from VAL to VAH. If you reject the point of control, you're not gonna rotate. That's why it's crucial when you do take this type of trades to take profit at that point of control, because it's gonna act as a magnet. And if you reject the magnet, bless me. Now, that's another example. Ethereum USDT on a very high time frame. What did you do? You break down a previous range with an imbalance and you create a new balance and you start rotating. VAL, VAH, VAL, point of control, you consolidate into it. You come into the value high, you consolidate into that, you tap it, you fail to rotate, and you create an imbalance, and you start impulsing back to what? To the previous balance. Now, the way you identify the difference, and just to give you a quick tip, this balance and imbalance means balance is when you have equal supply and demand. Imbalance is when you have either more demand than supply or the other way. So the key tools to identify them, volume profile. So on the volume profile, this highlight the areas of high and low participation. This is for a tool. Then you have the price action. In terms of a price action, you're gonna see a consolidation or a breakout. And in terms of indicator, you can use maybe a Bollinger Band, or you can use a counter band. And just to give an example, when price is stuck in a narrow range with low volume, it's balanced. A sudden spike in volume and a breakout, well, that's your imbalance. Now this is an example where I have used counter bands. You can clearly see the low of the band, high of the band, high of the band, low of the band, high of the band, and then you start impulsing higher. Another example, counter band, low of the band, high of the band, low of the band. That's just an example what you can do besides the volume profile. Now, how to trade balanced and imbalanced markets. First, if you're trading a balanced market, the strategy is buy low, sell high. Simple. Risk management, you need to use tight stop losses near the support and resistance, because you're gonna be focused on that risk to reward to be more than 1.5. And in a balanced market, patience is key, profit lies in the edges, so you want to be trading the extremes. Trading in the imbalanced markets, this is basically you're going to be trading the breakout or the trend continuation. In terms of risk management, I suggest you use trail stops, because when you're having that breakout and you want to be trading this breakout, you want to trail your stop, because what happens if you have a longer stop loss and you just do that fake out and you come back in, most likely what's going to happen is you're going to get stopped. And if you use a trailing stop, your stop loss overall is going to be much smaller in terms of percentage or widened. So when a bounce is imbalance, ride that trend but manage your risk, because it can turn very quickly. So just to give you a recap, the balanced market is about patience and precision, and the imbalanced market is about seizing opportunities. You need to master these dynamics and you're gonna have a huge edge into trading any market, doesn't matter if it's crypto, forex or indexes. That's for me. I wish you all the best and take care.